$847 billion. That's how much US Treasury debt China sold in the last 18 months. Not speculation, not rumor. Official Treasury Department data you can verify yourself right now. And here's what should terrify you. Japan, America's closest ally, the country that's been buying US debt for 40 straight years, just did the exact same thing. $264 billion sold since January 2022. Saudi Arabia, selling. Belgium, reducing holdings by 43%. Switzerland, dumping treasuries month after month. France, quietly exiting. The 6 largest foreign holders of US debt are selling simultaneously. This isn't politics. This isn't coincidence. This is a pattern, a mathematical pattern I've studied for 50 years. Ray Dalio has been warning about this specific pattern for years. The same pattern that destroyed the Spanish Empire in 1557. The same pattern that collapsed the Dutch Republic in 1795. The same pattern that ended British financial dominance in 1976. Spain, the Netherlands, Britain, 3 global superpowers, 3 reserve currencies, all followed the exact same 4-stage cycle from dominance to collapse. Same warning signs, same timeline, same devastating outcome. And America just entered stage 3, the exodus stage, the capital flight stage. Stage 3 doesn't last forever. Historically, it runs 18 to 36 months from start to finish. We're approximately 18 months in right now. That means you have maybe 12 to 18 months left to reposition your retirement accounts, your savings, your family's financial future before stage 4 hits. And stage 4, that's when everything collapses. I predicted the 2008 financial crisis when everyone said housing prices could never fall. I've studied every major debt cycle in the last 500 years. By the end of this video, you'll understand exactly what's happening. You'll see the pattern with your own eyes. You'll know the timeline. Let me show you how this works. Here's what nobody's telling you about reserve currency collapse. It's not random, it's mathematical. 4 stages that repeat every 75 to 100 years throughout history. Stage 1, ascension. A nation becomes the center of global finance. Capital floods in from everywhere. Their currency becomes the standard for international trade. Banks expand, markets boom, innovation accelerates, the future looks limitless. The stage lasts 50 to 80 years. Stage 2, overextension. Success breeds arrogance. Government starts spending beyond its means. Military expansion, foreign wars, domestic programs, all funded with borrowed money. Debt grows faster than the economy can support. But nobody worries because asset prices keep rising. Real estate booms, stock markets hit records. Central banks print money to keep it going. This stage lasts 20 to 40 years. Stage 3, silent exodus. The smart money sees what's coming. Not the public, not the politicians, but the people who actually read balance sheets. Major institutions start quietly rotating capital out. No announcements, no press releases, just systematic calculated movement. Foreign central banks reduce holdings month after month. Sovereign wealth funds diversify away. Wealthy families transfer assets internationally. The exodus begins slowly, then accelerates. This stage lasts 18 to 36 months. Stage 4, collapse. The currency loses reserve status. Foreign central banks dump holdings. Interest rates spike, inflation explodes, asset prices crash simultaneously. Banks fail, pensions evaporate, the middle class gets destroyed. Political chaos follows. Most people never see stage 3 happening because it's quiet, technical, boring balance sheet adjustments that don't make headlines. By the time mainstream media covers it, you're already in stage 4. And stage 4 is catastrophic. Now let me prove this pattern is real with 3 historical examples. 3 global superpowers, 3 reserve currencies. Same exact cycle, same exact outcome. 1500s, Spain, the most powerful empire on earth. Not contested, not debatable. Absolute dominance. Spanish galleons returned from the Americas loaded with more gold and silver than had ever been seen in human history. The treasure fleets of the Indies were legendary. One fleet in 1545 carried 16,000 kilograms of gold and 200,000 kilograms of silver in a single voyage. That's $980 million in today's money from one fleet. And the fleets came every year. The Spanish real became the global reserve currency. If you wanted to trade internationally anywhere in the world, you needed Spanish rolls. Madrid was the financial center of Earth. Stage one complete, then came King Philip II, brilliant administrator, devout Catholic, terrible with money. Philip fought wars with everyone. France, England, the Ottoman Empire, the Dutch rebels. Spanish armies were stationed across 3 continents simultaneously. By 1550, Spanish government spending was running at 300% of tax revenue, 3 times what they collected. The difference? Borrowed from Italian banks, German merchant houses, Dutch financiers, anyone who would lend. And people did lend because gold kept flowing from the New World. Asset prices in Spain kept rising. Everyone felt wealthy. The Spanish economy looked unstoppable. Stage 2 complete. Then in 1555, something changed quietly. Major Spanish banking families started moving assets to Genoa. The Fugger family of Augsburg, Spain's biggest creditors, started demanding repayment in gold instead of promissory notes. They wanted physical metal. They wanted out. Wealthy Spanish merchants began transferring operations to Amsterdam. Not shutting down in Spain, just gradually shifting. Opening offices in the Netherlands, moving inventory north, redirecting trade routes. Why? Because the smart money could read financial statements, and those statements revealed Spain was functionally bankrupt. The Spanish government was paying 40% annual interest on some loans. 40%. That's not the interest rate of a strong government. That's desperation. But the public didn't know. Politicians denied it. The financial system pretended everything was fine. Meanwhile, the smart money quietly left. Stage 3 complete. On June 1st, 1557, King Philip II declared the royal treasury was exhausted. Spain couldn't pay its debts. Spain defaulted. Credit markets froze instantly. Spanish government bonds became worthless overnight. Banks that had lent to Spain faced ruin. The king seized private gold shipments to pay soldiers who were threatening mutiny. Philip promised it was temporary. Everything would be fine. It wasn't temporary. Spain defaulted again in 1560, again in 1575, again in 1596, again in 1597. 4 complete sovereign defaults in 40 years. By 1600, the Spanish real was worth 1/3 of its former value. Inflation destroyed the Spanish middle class. A loaf of bread that cost 2 reals in 1550 cost 15 reals by 1600. Savings accumulated over a lifetime became worthless. Spanish power evaporated. By 1640, Spain was a second-tier power. The empire fragmented. Economic stagnation became permanent. Stage 4 complete. Where did all that capital go? North, to the Dutch Republic, to Amsterdam. 1600s, Amsterdam, the richest city in the world. The Dutch East India Company was worth $8.28 trillion in today's money. Apple, Microsoft, Amazon, Google, and Tesla combined are worth about $9 trillion today. One Dutch company in 1637 was almost as valuable as the 5 biggest tech giants in 2026 combined. Dutch banks finance trade across the entire globe. The Amsterdam Stock Exchange, founded in 1602, was the first in history. The guilder became the global reserve currency. Capital flowed into Amsterdam from everywhere. Amsterdam in the 1600s was like Silicon Valley, Wall Street, and London, combined into 1 square mile. Stage 1 complete. Then came the wars. Always the wars. 3 Anglo-Dutch wars between 1652 and 1674. Wars with France under Louis XIV. Colonial conflicts with Spain and Portugal. The Dutch military presence stretched from Indonesia to Brazil to South Africa. All of it cost enormous amounts of money. Dutch government debt increased from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in 40 years. To pay for it, they printed money. The Bank of Amsterdam, founded in 1609 as the most respected financial institution in Europe, started issuing more receipts than gold it actually held. Fractional reserve banking before it had a name. Meanwhile, tulip mania hit. In 1636 and 1637, tulip bulbs were selling for more than houses. A single Semper Augustus bulb sold for 6,000 guilders. That was 10 times the annual income of a skilled craftsman. A flower bulb. Asset prices completely detached from economic reality. Everyone was getting rich on paper. Stage 2 complete, but something was wrong. The Bank of Amsterdam was running a secret. They'd been lending out depositor money to fund government wars. For every 100 guilders deposited, they only kept 25 in the vault. The other 75 lent to the government. It worked as long as depositors didn't ask for their money back all at once. It was a Ponzi scheme dressed in legitimacy. By 1690, the smart money started to see the cracks. Major banking families, the Portuguese Sephardic Jews who'd helped make Amsterdam wealthy, began transferring operations to London. German financiers pulled capital out gradually. English merchants opened offices in Britain. This wasn't panic. This was quiet, systematic withdrawal. The insiders knew the Bank of Amsterdam was functionally insolvent. Stage 3 underway. For decades, the secret held. New deposits covered old withdrawals. The government kept borrowing, the bank kept lending, but in 1772, a major depositor demanded full withdrawal. If the bank didn't have it, they stalled. Word spread. Within weeks, other depositors started demanding their money. The bank couldn't pay everyone. The secret was exposed. The Bank of Amsterdam had been insolvent for over 100 years. A century of fraud held together by reputation and lies. In 1795, French revolutionary armies invaded. The Dutch Republic fell. The guilder collapsed. Depositors lost everything. Riots erupted in Amsterdam streets. The government fell into chaos. The Dutch Golden Age, 200 years of dominance, ended. Stage 4 complete. Where did the capital go? London. Britain was next. The sun never sets on the British flag. You know that line. At its peak in 1920, Britain controlled 23% of the world's population. 458 million people under British rule, a quarter of Earth's landmass. The pound sterling was the global reserve currency for over 200 years, longer than any currency in modern history. The City of London was the center of global finance. Need capital for a railroad in America? Go to London. Need financing for mines in South Africa? Go to London. British banks financed infrastructure on every continent. Over 60% of international trade settled in pounds. British power seemed infinite, permanent. Stage 1 complete. Then came the 20th century and 2 world wars. World War I cost Britain £44 billion. That's over $600 billion in today's money. They borrowed from America, from their own citizens, from anyone who had lent. British government debt went from 30% of GDP in 1914 to 130% by 1920. Remember that number, 130%, the same level America is at today. They tried to return to the gold standard in 1925. Winston Churchill, as Chancellor of the Exchequer, wanted to restore the pound to its pre-war value. It was a disaster. British exports became too expensive, unemployment soared, the economy stagnated. They abandoned gold in 1931, returned briefly, abandoned again in 1933. The system was breaking. Then World War II made everything worse. More debt, more printing, more promises they couldn't keep. Britain ended the war technically victorious, but financially destroyed, broke, depended on American loans just to survive. Stage 2 complete. In 1949, the quiet exodus began. Nobody noticed at first. Major British corporations started shifting operations. Unilever, which had been headquartered in London since 1872, restructured with dual headquarters. Shell, British Petroleum, Imperial Chemical Industries. They were leaving Britain entirely, just gradually shifting investment, building facilities in America instead of Britain. Wealthy British families started transferring assets overseas, to Switzerland, to America, to Canada. Anywhere that wasn't overtaxed, overregulated, declining Britain. The brain drain accelerated. British scientists moved to America. Engineers moved where aerospace was booming. Entrepreneurs moved where opportunity existed. Britain offered high taxes and declining prospects. America offered growth and possibility. By 1960, foreign direct investment in Britain had fallen 62% from pre-war levels. The money was leaving, the talent was leaving, the future was leaving. Stage 3 complete. On November 18, 1967, Prime Minister Harold Wilson went on television and told the British people the pound had been devalued 14.3% overnight. One day you go to sleep. Next day you wake up. Your currency is worth 14% less. The government had no choice. They'd spent years burning through foreign currency reserves, trying to defend the exchange rate. The game was over. Then in 1976, the unthinkable happened. Britain went to the International Monetary Fund for a bailout. A bailout. The former global superpower, the empire on which the sun never set, had to beg the IMF for emergency loans like a developing nation. The humiliation was complete. The pound lost its reserve currency status permanently. International trade shifted to dollars. Britain's century of financial dominance ended forever. Stage 4 verified. You see the pattern? Spain, Dutch Republic. Britain, 3 empires spanning 500 years. Same 4 stages, same warning signs, same outcome. And every single time, the smart money left quietly before everyone else realized the ship was sinking. Now let me show you why America is in stage 3 right now. July 1944, Bretton Woods, New Hampshire. Representatives from 44 nations gathered to rebuild the global financial system. The decision was unanimous. The US dollar would become the world's reserve currency, backed by gold at $35 per ounce. Why dollars? Because America emerged from World War II as the only major economy intact. Europe was in ruins. Asia was devastated. America had 50% of global manufacturing capacity. Capital flooded into America from everywhere. US stock markets became the deepest, most liquid on earth. Everyone wanted American assets. The American Golden Age began. 1945 to 1971, 26 years of absolute dominance. Stage 1 complete. Then on August 15, 1971, President Richard Nixon appeared on television and announced the United States was ending gold convertibility. No more $35 per ounce. No more gold backing. The dollar became pure fiat currency, backed by nothing except faith and trust in the US government. And when all limits are removed, spending explodes. 1980, US national debt was $900 billion. 1990, $3 trillion. 2005, $5.6 trillion. 2008, $10 trillion. 2020, $27 trillion. January 2025, $36.1 trillion. December 2025, $38.4 trillion, a 4,200% increase in 45 years. The debt more than doubled in just the last 5 years. But that's only government debt. Corporate debt, $13.5 trillion. Household debt, $18 trillion. Sold-to loans, $1.77 trillion. Credit card debt, $1.1 trillion. Auto loans, $1.6 trillion. Total U.S. debt exceeds $100 trillion. Auto loans, $1.6 trillion. That's 370% of GDP. For context, Spain defaulted at 200% debt to GDP. The Dutch Republic collapsed at 250%. Britain lost reserve status at 130%. America is at 370%. America is at 370%. And climbing. Now, to pay the interest on all this debt, the government spends over $1 trillion per year. $1 trillion just on interest payments, not paying down the debt, just interest. That's more than defense spending, more than Medicare, more than most entire government agencies combined. $1 trillion per year, forever. And where does that money come from? They print it. The M2 money supply increased from $15.5 trillion in February 2020 to $21 trillion by April 2022, a 40% increase in 26 months. The largest monetary expansion in American history by far. And what does that create? Inflation, asset bubbles, wealth inequality. The stock market hits all-time highs while real wages stagnate. Housing prices have increased 73% since 2019. Price-to-earnings ratios are at levels only seen twice before. 1929 and 1999, both times ended in crashes. Every asset class is simultaneously overvalued. The Federal Reserve's balance sheet grew from $800 billion in 2008 to $9 trillion in 2022. They bought treasuries, mortgage-backed securities, corporate bonds, artificially propping up asset prices. Stage 2 complete and mathematically verified. Now here's where it gets interesting. Stage 3, the exodus. In 2013, China held over $1.3 trillion in US Treasury securities. Today, 760 billion. They've sold 540 billion over the last 12 years. But the selling has accelerated dramatically in the last 18 months. 847 billion sold since July 2024. Japan, the largest foreign holder of U.S. debt, held 1.32 trillion in 2022. Today, 1.3056 trillion. They've sold 264 billion in just 3 years. Saudi Arabia has reduced holdings by 38%. Belgium, which holds treasuries for other European entities, has reduced by 43%. Switzerland is selling. France is reducing exposure. The Cayman Islands, which represents hedge funds and financial institutions, is selling. Even the Federal Reserve itself is reducing its balance sheet. Quantitative tightening, letting bonds mature without reinvesting, draining liquidity from the system. So here's the trillion-dollar question. If China is selling, Japan is selling, Saudi Arabia is selling, Europe is selling, and the Fed is selling, who's buying U.S. Treasury debt? The answer should terrify you. Mostly the U.S. government itself. Government pension funds buying treasuries. The Federal Reserve buying during crises. Circular financing. That's not strength. That's desperation. But it's not just governments. Look at what major financial institutions are doing. BlackRock, the world's largest asset manager, $10 trillion under management, has restructured portfolios over the last 2 years. Reduced U.S. Treasury exposure, increased positions in emerging markets, European infrastructure, Asian real estate, gold and commodity exposure. They're diversifying away from concentrated dollar exposure. Diversifying away from concentrated dollar exposure recommendations in 2024. Goldman Sachs reduced U.S. equity overweight recommendations. Morgan Stanley increased international allocation guidance. These aren't random moves. These are the largest financial institutions in the world systematically reducing dollar exposure. The smart money is moving. Stage 3, verified. We're approximately 18 months into an 18 to 36-month window. That means you have maybe 12 to 18 months left. So what happens next? Stage 4. The dollar gradually loses reserve currency status. This won't happen overnight. There won't be a single announcement. Gradually, then suddenly, countries will start settling trade in other currencies. China and Brazil are already trading in yuan. India and Russia settling in rupees. BRICS nations developing alternative payment systems. Over 40% of global GDP is now in countries building infrastructure to bypass the dollar. In June 2024, widespread reports said the petrodollar agreement ended. Let me be clear. The 1974 U.S.-Saudi Joint Commission on Economic Cooperation expired. There was never a formal written requirement for Saudi Arabia to price oil exclusively in dollars. It was an informal arrangement. But Saudi Arabia has now publicly indicated willingness to accept other currencies for oil. They're exploring yuan-denominated transactions. The practical effect is the same. The dollar's exclusive grip on oil markets is loosening. Now, when dollar demand drops, what happens to all those dollars sitting in foreign central banks? They come home. Trillions of dollars flooding back into the U.S. economy. That's when inflation goes vertical. Not 8%, not 10%, 20, 30, 50%. The Fed will face an impossible choice. Option 1, raise interest rates dramatically to crush inflation, but that makes the $38 trillion debt completely unpayable. Interest payments alone would consume the entire federal budget. The government would have to default. Option 2, keep printing money to service the debt. But that destroys the currency through hyperinflation. Either path leads to the same destination. Asset prices collapse because liquidity disappears. Stocks crash, bonds become worthless, real estate can't find buyers, banks fail, pension funds go insolvent, insurance companies collapse. The cascade begins. And the middle class, holding most of their wealth in dollars and dollar-denominated assets, gets completely wiped out. Savings evaporate. Retirement accounts vanish. Home equity disappears. This isn't speculation. This is the pattern. And it has happened every single time. Spain had the most powerful military in the 1500s. Didn't stop economic collapse. The Dutch had the most advanced financial technology in the 1600s. They invented modern capitalism, stock markets, central banking. Didn't stop collapse. Britain had the largest empire in history. The Industrial Revolution, a global navy, didn't stop collapse. Military power doesn't prevent economic mathematics. Technology doesn't stop currency debasement. Innovation doesn't overcome fiscal insanity. Exceptionalism is just a story empires tell themselves before they fall. Every empire thinks it's different. Every reserve currency believes it's permanent. They are always wrong. So what does this mean for you? 7 actions. Starting today. 1. Diversify out of pure dollar exposure. Physical gold and silver. Not paper gold, not ETFs. Physical metal you own and control. Gold has held purchasing power for 5,000 years across every civilization. Aim for 10 to 15% of liquid net worth. 2. Geographic diversification. Its major institutions are moving capital internationally. Consider following. Not all your money, but some. Stable foreign currencies. Swiss francs, Singapore dollars, Norwegian kroner. Spread political risk across jurisdictions. 3. Understand the timeline. Stage 3 lasts 18 to 36 months. We're probably 18 months in. You have limited time. Not years, months. 4. Increase liquidity. Keep accessible cash. Yes, cash loses value to inflation, but in a crisis, liquidity gives you options. Options to buy crashed assets when they appeared. Aim for 3 to 6 months expenses in cash equivalents. 5. Reduce debt. High debt in a rising rate environment is financial suicide. If you're deleverage now. Every percentage point interest rates rise makes your debt more expensive to service. Pay down credit cards, pay down variable rate loans. 6. Invest in skills. The one asset that survives every collapse is human capital. Skills that create value, knowledge that solves problems, relationships built on trust. These can't be inflated away, can't be confiscated by governments. 7. Stay informed. Subscribe to this channel right now. Hit the notification bell because the next video breaks down exactly which sectors historically outperformed during stage 4. Which assets preserved wealth through hyperinflation? Which ones completely destroyed it? I'll show you what happened to real estate during Spain's collapse. What happened to stocks during Britain's currency crisis? What happened to commodities, to gold, to agricultural land throughout every major currency devaluation? China sold $847 billion for a reason. Japan sold $264 billion for a reason. BlackRock is diversifying for a reason. They see the same pattern you just learned. The same pattern that destroyed Spain, that destroyed the Dutch Republic, that destroyed Britain. We're in stage 3, the capital flight phase, the silent exodus. The smart money is leaving. Stage 4 is coming. And the mathematics are inevitable. The only question is whether you'll be positioned correctly when it hits, or whether you'll be asking like millions throughout history, how did I not see it coming when all the signs were there? The information is here. The data is verifiable. The choice is yours. Drop a comment below right now. Tell me, which stage do you think America is really in? What are you doing to prepare? Hit that like button if this information changed how you're thinking about your money. Subscribe now because the next video reveals the 3 specific sectors that historically outperformed during currency crises. Sectors that could protect your wealth or position you to profit from what's coming. Thanks for watching. And remember, the people who survive these transitions aren't always the ones with the most money. They're the ones with the best information and the courage to act on it. See you in the next video.